Good.
Yeah, sure. Accounting, chapter 14, partnership. But before we go deeply into partnership, there's a note about the introduction, which is about sole traders. When we talk about sole trader, it's a business owned and controlled by an individual. That's why we call it a sole trader. And we have different features of a sole trader. A single owner provides the capital. Because it's a sole trader, that means the owner of the business will provide mainly the amount of money needed for the business. Owner has rights to all profits earned. Because it's the owner of the business, he or she has put a lot of money into the business, the reward or the return on the investment, it's solely to that owner. Owner pays income tax. Unlike limited companies, they pay corporation tax. So for partnership, for sole traders, they pay income tax, just like individuals. Clear? The owner is responsible. Owner is responsible for all debts of the business. Then because it is unlimited, it's a sole trader, it's unlimited liability. So the debt of the business can be transferred to the owner of the business. That's the point there. The next one, owner can take legal actions or can have legal actions taken against them. There's no different entity. There's no entity between them. So that means you cannot separate the owner of the business from the business. So whatever legal actions that can be taken, it can be taken onto the business, or the business can take a legal action too. Do you understand?
But what if there's many owners?
No, it's a sole trader.
That's why.
So.
But what if the owner has any other in hierarchy? What's called hierarchy? Managers underneath him, and
it is still a sole trader.
What if he has stakeholders?
Stakeholders are in every business.
So why do they not even face the debts and face all this?
No, because it's a sole trader. A sole trader is the sole owner of a business.
Like a
whoever
small
he or she deals with or relates with doesn't matter.
Small business.
You could be a big business and still be a sole trader. In as much as you're a sole trader, your debts cannot be transferred to others.
But they have stakeholders.
Every business has a stakeholder. A stakeholder is an
Does he not face?
No, stakeholders are people that have interest in our business. Customers are your stakeholder. Sole trader has sole trader. Every sole trader sells to a customers. Customers are stakeholder. Government is a stakeholder. Okay. The bank they borrow money from is a stakeholder. Their supplier is a stakeholder. Okay. So stakeholders are different. But what we're saying is the debts of the business cannot be transferred to others except for the owner of the business.
Okay.
Is it clear? So now that takes us to partnership itself. So when we talk about partnership. So when we talk about partnership, a partnership is just a business that is owned by 2 to 20 people mostly. 2 to 20 people.
2 to 20.
Yes. Is it clear?
Yeah.
So that's why we call it partnership. Then we go to...
Not 22, 23?
No. It becomes a private limited company.
Private limited.
Yeah. So we go to partnership. We go to the features of partnership. Are you there?
Yeah.
1. No formal agreement is required. Only the Partnership Act of 1890. So because it's a partnership, it's more like a sole trader. But the difference is that it has more people involved. And one of the features is that you don't need the article of association or memorandum of association from the registrar. The registrar of companies does not need to. You don't need any paperwork to start it up. You can just sit down now and we start a partnership, like the one you said earlier. Do mention, okay? Partnership are entitled to share of profits. So when we talk about partnership, so the profits shared, the profit made by the business, they all have entitlement to it. They share the profit. Each partner is an agent, which means each partner, whatever one partner does, it can affect all the partners. Risk is shared, which means all partners are liable. If one cannot, others will pay. In case there is a debt and one of the partner cannot pay, others have to pay it. Do you understand? So the inefficiency or the negligence of one partner can be transferred to other partners. Oh, okay. I think it's clear.
Do you think it's which better, is partnership or solo traders?
Well,
there's advantages.
There are the advantages. You have to compare. That's why you have to. There's always what we call cost analysis to check the cost benefit analysis to check the cost of sole trader, the cost of partnership before you make a decision.
But like advantages of sole traders, profit is owned to himself. But disadvantage is that the debt he has to be paid by himself. Yeah. By partnership, it's split up.
Yes.
The debts.
And also remember, for sole trader, the responsibility solely is on your shoulder.
Sure.
But as a partnership, you can have specialists,
exactly.
And responsibility is shared.
Yeah.
That's an advantage. So you have to weigh it up before you decide. So that takes us to. No, we continue. There is no legal requirement to disclose financial information to the public. It's part of the features. Do you see it here? Around somewhere here.
Yeah.
Continuation, yes.
It's a partnership agreement.
Okay. So another point is that there's no legal requirement to disclose financial information to the public, unlike a private limited company or public limited company, which you have to publish your financial statements. For partnership or sole trader, you don't have to. I think the point is clear. The death of a partner effectively means dissolution. There's what we call partnership dissolution, which means the partnership will end as soon as the death of one partner ends the business.
Okay.
Is it clear? Any question about that?
Yeah.
So that takes us to partnership agreements. Are you there?
Yeah.
So for partnership agreement, I wrote, partnership agreement is to regulate the way in which business affairs are conducted. So, when there's no agreement, when there are no terms and conditions, it might be difficult to start a business. So with your partnership agreement, it means we are able to sit down, put things in order, then our affairs are guided based on what we have both agreed upon.
Terms and conditions.
Yes. But in case there's no agreement intact, then we can use what we call the Partnership Act, or the Section 24 Partnership Act of 1890, which are: 1, profit and losses will be shared equally. Because there's no partnership deed, so it means profit and loss will be shared equally. 2, no salaries will be paid to any partner. None of the partners will get salary. Partners should not receive interest on capital invested. No matter what amount of money you put into the business, no interest is received. Partners' loans to the partnership are entitled to 5% interest. So because there's no agreement stated, so if there's a loan, 5% interest has to be given. Clear? No interest is charged to partners on drawing which they make. So in as much as you're not going to get interest on capital invested, you're not going to pay interest on cash withdrawn from the business. Is it clear?
Yeah.
That is drawings, what we call drawings. Is it clear?
Yeah.
So that takes us to accounting for partnership. Are you there?
Yeah.
So for accounting for partnership, be right back. Yeah, I'm back. Accounting for partnerships. So I want to talk about accounting for partnerships. But before we go into accounting for partnerships, the sole trader also has an account. But the account for a sole trader is different from the way accounts for partners are being prepared. For a sole trader will have amount of money invested into the business in his capital account. But for partners, each partner will have individual capital account combined with a current account.
Yeah.
So in partnership, we have current account, capital account, and appropriation account. Are you with me?
Yeah.
So that's what I wrote about. So for sole trader, I wrote, the capital account shows the capital introduced by the owner plus profit less any drawing made by the owner. So for a sole trader, it is capital invested, you less the drawing, and you have the profit. But for partnership, you're going to have the capital account separately, current account separately. They're going to have interest, salaries, and the rest.
Okay.
Do you get it? Any question about that? Okay. So we start with capital account. So for capital account, the items in the capital account are the amount of money invested in the business, the assets of the business, which these are going to be in the credit side of the capital account, the amount of money invested in the business, either cash or bank, the assets of the business, the balance. If there's any goodwill, and when we talk about goodwill, we're talking about the reputation of the business, customers' perception about the business, all these are going to be on the credit side of your capital account. Credit side. Yeah, this capital account, it's not the same as trading profit loss account. Now, on the debit side, that's current accounts. Okay, this one, right? So you're talking about this? Yeah, I wrote it already.
You said goodwill written.
There's goodwill introduced.
Oh.
Goodwill written off.
Okay.
So goodwill, whatever is staying into the business will be on the credit side of the capital account. So whatever is taken out of the business will be on the credit side, the debit side of the capital account. So goodwill, which is the reputation of the business, the perception of customers about the business, what people think about your business, in terms of value, will be on the credit side. Yeah. But if the goodwill is written off, it will be on the debit side. Yeah. If capital is being withdrawn, it's going to be on the debit side. Do you understand the difference between the debit side and the credit side of capital account? All what is being introduced into the business stays on the credit side of the capital account. All what is taken away from the business stays on the debit side of the capital account. Is it clear? Is it clear, please?
Yeah.
Now the current account. For the current account, I wrote, okay, for the current account contains rewards and costs of the partnership on each partner. The rewards and the cost of partnership on each partner. So what does that mean? So what are the purpose of preparing a current account? Are you there?
Yeah.
To inform the partners about how profit is being distributed. So the current account is where the profit is being distributed. So you are preparing that. One of the purpose of preparing a current account is to let everybody knows the share of profit. That's the first one. 2, to separate the capital contribution by the partner and the profit each partner received. So the point is, in your current account, there is what we call the interest on capital. So the interest on capital will be partner A, partner B, partner C. So each partner would have its own interest separated, and he or she can see it. The third one, I think that's the only point I made.
That's okay.
So now we go to the entries, the current entries and the credit, the current account entries for both
debit and credit.
credits, for both debit side and the credit side. The first one here is the balance breakdown, which is the amount of money that comes from the previous account or the previous year. It's going to be there, either on the debit. If it is on, it is on the debit. If it is owed, on the credit. Interest on drawings. When we talk about interest on drawings, that means the amount that has to be paid by each partner who has withdrawn capital or who has withdrawn fund from the firm or from the business. It's going to be on the debit side. Salaries paid. And when we talk about salaries paid, the one on the debit side here is the one that is due in the current period. There's 2 salaries here. There are 2 salaries here.
Yeah.
Salaries paid, which is on the debit side.
And salaries still.
Salaries paid here is the salary due for the current account here.
How are the salaries done in a partnership? Is it like split up?
Yeah, no, it will be based on the agreements made. You know, we have different type of partners. We have nominal partner, which is a sleeping partner. We have we call them dormant or sleeping partner. They only put money into the business. They contribute fund into the business. That's all. We have active partners. These active partners are partners who have investment into the business and also work in the business. They are the ones that are entitled to salary.
Okay.
So there's dormant or sleeping partner. Okay. They don't work in the business. They only contribute. They are not entitled to salary.
Yeah.
But for the active partner, they are entitled to salary because they put effort into the job.
Okay.
Is it clear? So salary pays here, this due to partners in the current period. That is the salary on the debit side.
Yeah.
Now, note, whatever is being paid or whatever is being taken from the business is always going to be on the debit side. Okay. But whatever goes into each partner will be on the credit side. Okay. Do you get it? That's what I'm saying here. So the interest on drawings, I explained that. Drawings itself, the amount of money withdrawn by each partner will also be on the debit side. Okay. The interest on drawings will be on the debit side of your current account. The salaries paid, the amount due will be on the debit side. The amount paid will be on the credit side as salary paid. Do you understand?
Yes.
There's share of loss. If there's a loss, it will be on the debit side. If there's profit, it will be on the credit side of your current account, please. You have to take note of these points. So the items on the debit side are drawings, the balance brought down, the interest on drawings, share of loss, salaries due. On the credit side, we have the salaries that has to be paid, the one recorded, the interest on capital. Interest on drawing on the debit side of the current account, interest on capital on the debit side. Yeah. But the capital is going to be on the capital account. On the credit side, capital introduced. Remember that? Share of profit will be on the debit credit side. Interest on partners' loans. If I have put a certain amount of money, I've loaned the partners. It's our partnership business, but I have loaned you. So the interest the business has to pay me interest. It will be on the credit side.
Okay.
Do you understand? Attached to the owner, to the loan, to the person, to the partner that has given out the loan. That's it about that. Any question about that? We're still on accounts. These are the current account and the capital account for partners. We'll be right back. So we're back. We'll go to statement of comprehensive income and appropriation accounts for partnership. For statement of comprehensive income, we simply know that That's where you get your profit from.
Oh, really?
Yeah. What is really? But when it comes to appropriation account is prepared to let each partner understand the amount of money that their share of profit, their share of profit or loss, their salaries that has to be paid are all in the appropriation account. So as soon as the appropriation account is done, whatever you get, whatever interest that has to be paid must be deducted before you get the final profit. That's why we have appropriation account. So whatever information you get from your appropriation account, you have to deduct it before you have your final profit.
Yeah, I see.
So,
Mister.
okay, so we go on. So statement of comprehensive income and appropriation account. Stop that already, please. So one, the interest on drawings, which is part of our statement of profit or loss. Interest on drawing. What is the purpose of the interest on the drawing?
Dr. What is withdrawing too much?
To discourage partners from withdrawing funds from the firm. That is the purpose. So what is the effect on appropriation account? It increases as partners pay interest on the firm, to the firm. So your appropriation account will increase because interest on drawings means that more money comes to the business. And what is the effect on current account? The current account will decrease because each partner has its own current account. So if a partner is paying interest on drawings, it would have meant that amount will be taken away from the salary from the partner's income. Do you understand? That is for interest on drawings. Then we go to partners' salaries. For partner salary, this is a reward for putting effort physically into the business. The mental is there for everyone, but the physical one, that means an individual or a partner is working. That's an active partner. So that's the reward for an active partner. So what is the effect on appropriation account? The purpose is to reward the active partner, right? Then what is the effect on appropriation account? It decreases because payment is made from the business. Then the effect on current account, it will increase because that active partner will be getting certain amount from the business. Is it clear? Then the interest on capital, which is the third one. When we talk about capital, the amount of money invested into the business, right?
Yeah.
So for interest on capital, the reward is to continue to encourage partners to put money into the business.
Okay.
So that's a reward for you for the risk you take in the course of putting your money into the business. That is the reward you get. Do you understand? That's the purpose, to reward you for putting your money into the business, which is a risk. Then what is the effect on appropriation account? The effect is that it decreases because the business has to pay partners from the profit made.
Yes.
You get it? Then the effect on current account. The current account will increase because that individual who has put money into the business will be rewarded for that.
Yes.
Is it clear? So that's the third item in the comprehensive income and the statement of comprehensive income account. Then the fourth one, share of profit. Yeah, the share of profit, that's the fourth one, share of profit. For share of profit, the purpose is to distribute the remaining profit made. You have to distribute the remaining profit. What's the effect on appropriation account? It decreases because you are paying partners from the profit.
Yeah.
The effect on the current account, it will increase because each partner will be having certain amount of money added to their income. Is it clear? So what are the rules you have to follow when preparing the statement of comprehensive income as a partner? Number one, each partner has his or her own capital and current account. So each partner must have his or her own current account and capital account. Two, capital account is fixed in terms of the amount injected, which means you cannot just add any amount of money during the course of the year. It is not possible. You can give a loan, yes, but to add in terms of capital, no, it is not possible. Okay. Because it will change the face of how profits or losses will be shared. Do you understand? Yeah. So the third one, if any loans are made by the partners to the partnership, it must be shown separately. So if loan is given, it has to be on the separate account.
Okay.
Clear? Then we have the next one. Interest on these loans is shown in the statement of profit or loss. Another comprehensive income before arriving to the profit for the year.
Yeah.
So if interest has to be paid on the loan, it has to be part of the expenditure, which shows
end of the year
in the statement of profit or loss account.
Yeah.
Before you get your final profit.
Perfect.
And the last one, the appropriation are generated from the profit for the year. So the profit account, your profit for the year, after you prepare your profit for the year, then you prepare the appropriation. Any question about it?
No.